Yo, welcome back to the Paper Chase. I'm Ebbs, you can know me for those who don't know me, and as you can probably tell by the title of this one, we're going to be talking about why you should be investing in the stock market and why it's become popular over the past, let's call it 12 months, and it seems like everyone's talking about investing in some sort of way right now. So before we start this video, obviously because I'm going to be discussing financial topics and financial instruments, I just want to say I'm no one's financial advisor, least especially yours. I'm just some guy on YouTube who's read a few books and has been in the stock market for a little bit and is just telling you what he's done and what he's doing and what he's learned. So by all means, take this however you will, but whatever you do, that's on you, bro. Don't sue me, bro. Thanks, man. Okay, so why invest in the stock market? There's a whole plethora of reasons why you would want to do that, but the way I want to explain it is to explain to you what happens to your money over time, like over a span of time, what actually happens to your money if it's just sat in your bank account or in a savings account, etc. And to be able to explain this, I need to talk about inflation. Now, what's inflation? Inflation is basically the general increase in the price of things that we pay for, that being goods or services, over time. And then as a byproduct of that, your money actually is worth a bit less than it was beforehand. Now that seems very confusing, but I'll explain it. Now, the average inflation in the UK is around 2%, meaning every year you expect the prices of things to go up by around 2%. Some years it's higher, some years it's lower. So that's inflation. So when people say that your purchasing power goes down over time, what does that actually mean? Okay, use the Freddo example. Everyone loves to use the Freddo example. In 1999, a Freddo chocolate bar cost 10p. Now, 22 years later, a Freddo bar costs 30p. That's a 200% increase, meaning you're paying 3 times as much. The bar's not 3 times as big, it's the same bar of chocolate, meaning you're paying more now for what you were paying less for in the past. That makes sense, meaning your purchasing power goes down. You can afford less because everything costs more. That makes sense? I hope it does. So if you're just losing purchasing power over time, like this must have been happening for many years before now. What do people do about it? That's where interest rates come in. Now, the interest rate has 2 meanings depending on whether you're borrowing the money or saving the money. If you're borrowing the money, interest rate just basically means the extra money you have to pay back in interest to the bank or to whoever you borrowed the money from. That's the interest rate. The other interest rate for savings is basically money that you have in savings, how much interest you are earning on your money per year. That's the interest rate of savings. So it's 2 ways of saying the same thing. It just depends on if you're borrowing or if you're saving. If the inflation rate is lower than the interest rate, then in effect the money in your bank account is actually growing over time. For instance, let's use 2007 where the interest rate was 5.75. If the interest rate is 5.75, that means you're earning 5.75% on your money in your savings. However, the price of things are going up as the year goes along, and it's gone up by an average of 2% that year, meaning what you actually earn on your money was 3.75 because you're going to take away that inflationary increase. That makes sense? Hope it does. Now, let's look after the financial crisis where interest rates then plummeted. From 2009 onwards, the interest rate has been below 1%. And now because of the COVID pandemic, the rates were cut even further and it's at 0.1%. Meaning you're basically earning nothing on your money. You put your money in savings, you put 10,000 in savings, you look at it next year, it's basically 10,000. Did you earn anything really? No. The price of stuff still goes up. Obviously, inflation is at whatever percentage it's at, but you expect inflation to be around 2% a year. So you're losing about 2% of purchasing power in a year because interest rates are basically 0. Okay, so you know now that if you leave your money in savings, you're basically losing money. So what do you do about it? Now, the financial markets come in. You look for somewhere to invest your money that's going to give you a return that's at least higher than inflation, so you're earning money on your money. You could put money in stocks, you can buy real estate, you can invest in a business, you can do whatever you can do. But the most common ones is either put your money in bonds, put your money in stocks, or buy real estate. Real estate, for obvious reasons, not the easiest thing to do, especially as a young millennial in London where breathing costs you £13.50. It's almost impossible. Then you see the stock market where you put your money in, you might make some, you might lose some, but it's obviously that risk of losing money. Then you see the bond market where the money you earn on bonds is risk-free, and I'm going to explain that. Now, what's a bond? A bond is basically a loan taken out by a company or a government that which investors buy, and in return they get little interest coupons along with their bond. So for instance, let's say you bought £1,000 bond and every 6 months you get a £50 coupon. Now if that bond is a 2-year bond, you're gonna get 4 sets of £50 coupons, which is £200, meaning that your bond was worth a 20% yield, which is the extra money that you earn on top of the bond. Does that make sense? You started with 1,000, they gave you £50 every 6 months for 2 years, so you now have £1,200 by the end of the 2 years. Now, if you say that's risk-free because you give them the £1,000, they give you money, they give you back the £1,000 at the end, you might be looking at it like, so why don't people buy bonds then? Why would you go to the stock market where you can lose your money? I'll explain now. The most popular bond out there is the 10-year government bond. Now, if you look at the 10-year government bond before the financial crash, so that's before 2008, the bond rate was 5.5%. That's a good percentage to be earning risk-free. So by all means, people should have been buying bonds heavy then, because you're gonna get 5% on top of your money, risk-free. Financial crash happens, banks go up in a hoo-ha, bond rates fall. 2014, the bond rate is still around 3%, which is higher than average inflation. So you might still feel like, yeah, why not get a couple bonds? Today, after the pandemic, our bond rate is at 0.8%. Again, now that's lower than inflation. What's the point of buying a bond if you're gonna earn 1% on it? Not worth it really. So what happens next? You look for somewhere else to put your money, and in steps the stock market. Everyone has probably heard about the stock market, but what exactly is the stock market? The stock market is where shares are issued and traded, and this is generally done over an exchange. That exchange being the London Stock Exchange maybe, or the New York Stock Exchange maybe. An exchange is basically like, you can call it the supermarket. It's the Tesco's of stocks. The stock exchange is Tesco's, the stocks, the shares are all the stuff on the shelves. Point of the stock market? Well, a company may be trying to raise funds for whatever reason, so they go public. When they go public, it allows anyone in the public to be able to invest in that company and buy shares, which is a small portion of a company. So for instance, let's use my company, my imaginary great amazing company called the TPC company. Okay, so today it might be worth £100, and I'm like, okay, I want it to be worth £100, so I'm gonna make it a public company. I'm gonna have 100 shares, so each share is gonna be £1. I'm gonna keep as many, let's say I keep 50 or whatever. And then the other 50 you lot can buy. So the company's worth £100 if everyone's buying them for £1. Now, if in a year's time people are buying the little 1 shares of my company for £1.20, because that's what everyone thinks it's worth now, that means the accumulation of all of them should be £120. So the difference between £100 and £120 is a 20% increase. So this is what companies do basically to make money publicly. They take investors' money, they do with it what they will, the share price goes up or down, and in effect affects how much the company is worth. Now, we all know that the stock market goes up, we all know that the stock market goes down, but in the grand scheme of things, the stock market generally goes up. Over the last 100 years, the average return year on year has actually been around 10%. So that's higher than those bond yields, that's higher than inflation, it's higher than interest rates, and this is why the stock market is the golden goose, because you don't need to have 60 grand for a deposit, you can just invest what you got and make around 10% on your money a year. That's not to say that that's what you will make. You could make more. However, you could make nothing and you could lose every penny that you put in the stock market if that company decides to just kaput into thin air. So, like I said, don't sue me, bro. Do your research. Now, the possibilities on the stock market are endless, but they're not all positive. You might lose every single penny that you put in. I know I said it already, and I'm gonna say it again because the risks are very, very real. However, if you wanna enter into the stock market, the best thing you can do is to mitigate those risks as much as feasibly possible. Hence, doing your research on whatever you decide that you want to invest your money in. The most common advice given is buy what you know, because if you try to buy what you don't know and you get spun like a Beyblade, that's your own fault. You are at fault. So yeah, buy what you know. However, in terms of mitigating the risk, what can you do? You can put your money in an index fund maybe, or into a mutual fund where you just buy a group of things, and by diversifying you're basically lowering your risk. I'm going to do further videos on this stuff later on, but there's loads of ways you can work in the stock market. You could be passive and just buy funds on track, maybe one of the main funds or the index funds like an S&P 500 or a Nasdaq or a FTSE or whatever you want to track. Or you can be an active stock picker where you literally research all the companies you like and whatever, and then invest in the ones that you feel like it's worth investing in. Like I said, the stock market is full of endless possibilities, which means you can make endless gains also. But that just depends on how your cards fall on the stock market. Okay, well, I've obviously gone into a super roundabout way of explaining why I think so many people have gotten into the stock market. I hope it's useful to you, and even though I obviously didn't talk like heavily about the stock market, I hope like the interest rate stuff and the inflation rate, I hope that information is actually useful, and especially for people who have probably been hearing them words for years on end and don't really actually understand what they do or what is the meaning of them or what, like how they affect us. Yeah, I hope that information is useful. The next stock market video that I'll probably do will be now probably the how-tos and what apps to use possibly. Like I'm still figuring it out, but there will be more stock market videos. I plan on making those probably for the foreseeable future. That's probably where I'm gonna be focused over the next couple of videos. But yeah, until next time, sayonara, peace out, and okay, bye.